The Standard & Poor's Index, otherwise known as the S&P, the Dow Jones Industrial Average, and the NASDAQ. Three major stock indexes of US-based corporations. These indexes were created to give market participants a way to actually gauge the growth of the entire market all at the same time. This allowed investors to track price movements in one asset rather than the prices of thousands of companies to simply have an understanding of how our market was doing. In the world of crypto, there is not really anything that is an equivalent to that. The closest thing we have to an index is the total market cap that is tracked on websites like coinmarketcap.com and coingecko.com. But in this video, we are going to deep dive into a subject that may be completely new for some of you that are watching, but very familiar to anyone who is diversified into stocks and index funds. Regardless of your knowledge on the stock market, I am going to blow your mind with some of the historic price analysis and show you how all of crypto's success may be due to something you didn't even know about. This analysis took me a hell of a long time to organize, but I believe it is essential for you to understand if you are going to stand a chance in the months and years ahead. And the only thing that I ask from you is make sure you smash that like button, make sure you hit subscribe, boom, bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Now, let's get into the things that are moving in the background that nobody may have known about. Let's be real. Bull markets and bear markets have been around fighting the good fight for a very long time. We are currently in a 13-year macro bull market. And although that sounds good, that should probably scare the shit out of you. This bull market was kicked off by the recovery after the 2009 housing collapse. Thanks a lot, Bill Clinton. Sure, there have been significant corrections in the S&P during those 13 years, but those corrections have been the exception to the trend. And instead of focusing on the exceptions, serious investors zoom out and look at the bigger picture. When I zoom out, I see a 13-year bull market in the S&P. And not just any bull run. From 2009 to the all-time high in January of 2022, the S&P was aggressively bought to the tune of 650%. That is a bull market that the world has not seen in a long time, if ever. Now, all of this growth was brought on by some rock-solid innovations like mobile phones that became popular in 2010, which obviously opened the door to mobile shopping. Enter stage right, Amazon. That's big money right there. Then cloud computing and advanced data engineering unlocked massive potential for businesses to greatly improve the efficiency of operations and marketing. So there was absolutely very real growth that took place during this time. But something else was going on behind the scenes that really threw jet fuel on the entire market. At the beginning of 2009, when the S&P was tanking along with the 401ks of average Americans, the Federal Reserve decided to print dollars to purchase assets that would artificially boost up and prop up the economy. The announcement of this Fed intervention is arguably the main reason that the S&P even found an actual bottom in March of 2009. The intervention was very successful in bailing out the entire stock market, except you Lehman Brothers. The Fed Chair Ben Bernanke and the Federal Open Market Committee that dictates the US monetary policy decided that they would rather be safe than be sorry. But in their mind, safety meant continuing to spend billions of dollars per month to prop up the markets. Let me give you a sense of the scale that we are dealing with when it comes to the Fed's asset purchases between 2007 and the present. In the summer before the housing crash, the Fed's balance sheet consisted of about $900 billion worth of US treasuries. By May of 2013, the S&P had returned to its pre-crash highs. And at that time, the Fed balance sheet had almost 4x'd. Dude, a $3.3 trillion balance sheet is what it took for the Fed to drag the markets back out of the hole that the housing crash had dug. Many economists argued that what the Fed did next was an absolutely unequivocally massive mistake. They just kept printing, and that money printer was working overtime. Their goal was to help businesses generate revenue to be able to make new hires to fight more than 7% inflation at the time. For those of you who don't know, the Fed's unemployment rate target is about 4%. That means that in their mind, 96% of the able-bodied Americans that can work should be working. In the summer of 2013, the US headline said that the rate was cruising at a comfortable 1.25%. So this was the perfect combination of macro data to signal to the Fed that they could just keep printing money. So now that they knew that they only had 1.25% inflation coming in, Print money is what they did. Remember to like this video because this part of the story you are absolutely not going to like. From the summer of 2013 when the S&P had reached those pre-crash highs to the summer of 2022, the Fed ran up their balance sheet to $9 trillion. That's just another cool 3x. No big deal. Nothing to see here. That brings 2007 to 2022 total to a whopping 10x on the Fed's balance sheet in literally 15 years. That's absolutely insane. This was a stress test of the Keynesian economic theory that was a first for the modern Western world. Now, here's the kicker. Remember, Bitcoin went live in 2009, right at the beginning of a 13-year bull run. That means for the entirety of the lifespan of Bitcoin and cryptocurrency, the macroeconomic environment has been calibrated to stimulate growth and pump assets. So this is bad. This is bearish, and I will tell you why. This story really raises the following very tough question. Would Bitcoin have anywhere near the valuation that it has today without the Federal Reserve's ultra-aggressive monetary policy? It definitely wouldn't have the use case that it has. What would Bitcoin's all-time high have been if the Fed had ended its money printing in 2013? Of course, this is not possible to know, but I have to assume that the answer would be generally something along these lines. Bitcoin would be much lower. The S&P would be much lower. Google stock prices would be lower. The housing market would be priced much lower. And Elon Musk would probably not have to become the world's richest man. But who knows? We live in unprecedented times. It just doesn't feel like it because these macroeconomic effects have happened over such a long time span that you barely even notice it. Now, in this video, I showed you the story of the 650% rise in the S&P and how and why that rise happened. I linked that story to Bitcoin by suggesting that Bitcoin would be much less valuable if it were not for the Federal Reserve deciding to go burr and print that money. And in the next episode of this series, we are going to leave history in the textbooks and peer into the future of Bitcoin. Because here is a game changer. The Federal Reserve has completely changed course on its monetary policy as it tackles a new set of problems. Absolutely ridiculously high inflation. Is the stage set for a massive Bitcoin sell-off as the market realizes the truth that I've exposed in this video and series? Should you sell all of your Bitcoin? Well, I guess you'll just have to wait until the next episode to figure that out. I'm just kidding. I wouldn't do you like that. Of course you shouldn't sell your Bitcoin, but there is a lot that you need to consider, and I guarantee that you're going to want to show up to this video because there's a lot of stuff that you don't realize. So tell me in the comments section what you think. And if you like content like this, make sure you smash that like button. Make sure you hit subscribe. Boom! Bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Thank you so much for showing up to this video. I will see you in the next one. Have a good day, everyone.